We use it every day. We think about it even more. But what is money really? It's not just the cash in your pocket, it's a whole system. That's where M0, M1, and M2 come in. They represent different categories of money. At the base, you've got the most liquid forms of money. As you move up, it gets a bit more complex. Understanding these categories is key to understanding the economy. So, buckle up, because we're about to dive into the wild world of money supply. First up, we've got MZO, the base of our money pyramid. This is the most liquid form of money, including physical currency circulating in the economy and reserves held by banks at the Federal Reserve. It's the money you can use immediately to buy your morning coffee, or, a slightly used yacht. Next, we have M1, which builds upon M0. It includes everything in M0 plus demand deposits, which are basically your checking accounts. You can access this money quickly, making it almost as liquid as cash. One big change in recent years was reclassifying savings accounts as part of M1. This was a head-scratcher for some, but it reflects how easily people can now access their savings. Finally, we reach the top of the pyramid with M2. This broad measure includes M1 plus near money assets. Think savings deposits, money market funds, and small-time certificates of deposit, CDs. These are less liquid than M1, but still represent a significant portion of the overall money supply. The COVID-19 pandemic didn't just disrupt our lives, it turned the financial world upside down too. Remember all that panic buying of toilet paper and hand sanitizer? Yeah, that was just the beginning. M0 remained relatively stable throughout the pandemic. People still needed cash for essential purchases, even with lockdowns and restrictions. But things got more interesting with M1. It surged as people and businesses held on to more liquid assets due to economic uncertainty. Remember that reclassification of savings accounts? That amplified the growth of M1, making it a key indicator of the pandemic's economic impact. M2 experienced even more dramatic growth. Increased savings played a role as people held on to their money amidst job losses and economic anxiety. But the real driver was government intervention. Stimulus checks and increased unemployment benefits injected trillions into the economy, causing M2 to balloon. Section 4. Banks, the money multipliers. Believe it or not, banks don't just hold on to your money like some giant, heavily guarded piggy bank. They play a crucial role in creating money through a magical process called fractional reserve banking. Here's the gist. When you deposit money in a bank, they don't just keep it all in a vault. They lend a portion of it out to other customers. Those borrowers then deposit the money back into the banking system, allowing banks to lend out a portion of that money again. And so on, and so on. This cycle creates new money in the economy, effectively multiplying the initial deposit. The more banks lend, the larger the money supply grows. But don't worry, it's not a free-for-all. Central banks like the Federal Reserve set reserve requirements, ensuring banks keep a certain percentage of deposits on hand. Section 5. Riding the money wave. Recent trends in M0, M1, and M2. So, how have M0, M1, and M2 fared in these strange and uncertain times? Well, M0 has remained relatively stable. It seems people still cling to the comfort of physical cash, even in our increasingly digital world. M1, on the other hand, saw a significant surge during the pandemic. This was partly due to the reclassification of savings accounts, but also because people and businesses favored liquidity amidst economic uncertainty. It's like everyone collectively decided to keep their money close at hand, just in case. But the real star of the show has been M2. This broad measure of the money supply has expanded rapidly, fueled by increased savings and, more importantly, massive government stimulus. This rapid expansion has raised concerns about inflation as more money chases the same amount of goods and services. Section 6. The money show goes on. Impacts in the future. These shifts in the money supply have real-world consequences. A larger money supply can stimulate economic activity, but it can also lead to inflation. That's where central banks come in. They walk a tightrope, managing the economy and inflation. They adjust interest rates and implement policies. The future of M0, M1, and M2 remains uncertain. Will digital currencies disrupt the traditional system? Will governments pump money or tighten the purse strings? The money supply will continue to evolve. Understanding M0, M1, and M2 is crucial.